My name is Rick Bensignor. I'm CEO and founder of the Bensignor Group. This is a company that consults to institutional Wall Street portfolio managers. Also last year started an individual investor newsletter to help them get access to models that typically only institutions have. And I also do performance coaching for financial advisors on the street. Well, I started in the pits in 1983. I had graduated undergrad in 1981, had worked on the floor the prior 2 summers, so kind of lined myself a job for when I graduated, which was great because senior year of college, while all my other friends were interviewing, I was sitting back enjoying life because I already had a job lined up. So I worked for Prudential Bache right out of college. Upstairs, I was their first stock index futures analyst. This was the early 80s. The S&P futures had just started trading, the New York Composite Index, I think, a year later. And in 1983, the head of the commodity department offered me to go down into the stock index pit in New York and be Prue Bache's broker. So that's where I started and traded in the pits for, I think it was five years or so, until just after the crash in 1987. And then business kind of dried up in the stock index market, especially on the New York Composite Index, because it wasn't the primary market like the S&P. So I decided I'd take the chance in life to be a local, somebody who traded their own account. Now, I didn't have a lot of funds, but I figured I'm a decent trader. I think I can do this. So I just started trading speculatively, generally making a bid and selling the offer all day long, trying to take the VIG out in between the bid-offer spread. And that's what floor traders do. It's just they don't really position much. They take the VIG out. So you trade a couple hundred times a day. So I did this for a total of 12 years. But I definitely had an aha moment, let's call it, in 1990. I think it was the fall. They actually ultimately labeled this the mini crash. So I think it was an October day. It's about 2 o'clock in the afternoon. And I'm making a two-sided market like I normally did in the pit. And a broker behind me says, sell 10. So I bought 10 contracts at whatever the current bid was. And the first thing you do is kind of write it down. And before I even have it written down, there's this swell of noise, and I'm kind of looking around, something's going on. And all of a sudden you keep hearing people go, sell, 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 sell. And then a couple dozen brokers on the top step of the pit have both arms up and they're yelling at the limit, which means they're now offering the stock index futures contract down to the lowest price it can trade. So it is now plummeting in price. And now it artificially stops because it's not allowed to trade anymore. So the market actually closes for about 15 minutes back then. So the world could evaluate if this excessive move was really the right thing to do. Kind of, take the emotions out of it. Let's figure out what's going on. So the market's closed. And I'm looking and counting in my head how much money I'm down, if I could even sell them. But I can't sell them because it's limit down. Everybody in the pit is trying to sell. And it's far more money than I have in life. And I had no dad or uncle or somebody to go to say, hey, I need a couple $100,000 or something. My dad had already passed away, unfortunately, at an early age. And I'm like going, that's it. I'm done. My career is over. I've got to go home, tell my wife. I had a 3 or 4 month old. My first child had just been born that prior summer. And kind of say, I've lost everything. We're going to have to move. We have to sell the house. Life's over as you know it. While the market's limit down, a broker behind me says, who needs to sell some? And I got in his face, almost nose to nose, and I said, me. And he goes, buy 15. So now I've locked my loss. I had been long. I'm now short 5 extra contracts at limit down. So I can't make any money on those either, but I've locked my loss. 15 minutes later, the market reopens, and there's all these unfilled sell orders from all the brokers around the pit. So right away, we open down the next limit down, which has even expanded a larger range than from the first limit that it could trade. So I buy back, if I remember correctly, 7 contracts at limit down, and then we start rallying big, and very quickly I sell them out. And I start doing the math, and I look at, okay, I locked the loss here, how much I was down, but I just made a good chunk of money. And it ends up that day was the second best day I ever had in the pit. So I went in a matter of 20 minutes from the day that was essentially ending my career on Wall Street to a very profitable day. So you're talking about a humbling experience and an aha moment. That was mine. What it made me realize for the rest of my career is that you can have a lot of skill, but luck plays a lot of role also in people's success or failure. It could be right place, right time, wrong place, wrong time. I'm just making a two-sided market the way local does. It's just, some news had come out that made everybody become sellers, and I've got these huge losses. So, my takeaway has always been be humble, realize any moment things in life can change. Be thankful for what you have. And it gives you a little extra sense of, kind of be careful. Don't go for the home run. Singles, doubles, and the occasional triple is worth, if you're a consistent good trader, you can make good money over time. But going for the home runs can also take you out of the game very quickly. It's changing big time. A lot of previously successful people in the industry have stepped away over the last several years because the game has changed so much. A lot of it you have to credit or discredit the amount of algorithmic trading, the electronic trading that exists in the marketplace. Somewhere between 60 and 70% of all trading that's done on the New York Stock Exchange is done through algorithms. This is a huge cry from how business was done 20 years ago. It basically means you're playing against computers all the time. So the classic investors are seeing swings. The S&P can move 20 full points in 10 minutes sometimes. That's the Dow moving a couple hundred points in minutes. Now, of course, they're higher priced instruments, so the Dow 25,000 moving 1,000 points is very different than when the Dow was at 10,000 moving 1,000 points. But the point is that these computers tend to jump on board each other. And so we start moving up, and then other signals kick in, and sooner or later, everybody's model is going to be doing the same thing. So you get these huge moves out of nowhere. Do not play the game of day trading. That is a losing proposition nowadays. It is very, very difficult for the average person to beat the computers. The minute they lift an offer thinking something's going up, the stock is 10 cents down on them. It's uncanny that virtually every decision you make is wrong from the start. No matter how good your analysis is, this is what computers have done to the game. You're kind of taken for a knock the moment you get in. So it hurts the psychology a little bit. You think you're right. You don't get into a trade unless you think you're making the right decision. And then as soon as you do, somehow, it's in your face. So computers are making a big change to the industry. And then the way people react to what's going on in the marketplace is also evolving more and more. And let's even take what's going on now in the markets. You sell off in December. You have half of Wall Street saying we're in a bear market. We took out the lows from February, so now you really have people saying this is, terrible. And so now people are looking to sell every bounce. By, I think it was January 10th, plus or minus a couple days, we were in print and telling our clients, A, there never was a bear market. B, we're not in the midst of a bear market. And C, and most importantly, the low in December around Christmas time was the low, not just for the U.S. market, but for all global major equity indices. So that's the end. Whereas the U.S. really didn't fall apart until fourth quarter last year, Europe and Asia had been falling the entire year. The signals I have said that ended on the December decline. Therefore, you've got the entire globe coming back. So not only do you not have to worry about the U.S., you actually want to start coming back into Europe and Asia. So we've been bullish China since mid-December, when everybody's thinking the world's falling apart. So part of the game now, too, is really taking advantage of all the cognitive and emotional mistakes most portfolio managers tend to make at the extremes of moves. If you had a stock that went from 60 up to 100, pulls back to 80, goes to 95, pulls back under 80, most people are going to say, it's kind of a double top in the mid to upper 90s. We're now under that middle point of the sell-off. It's a sell. And it might be, but you're 20% off the highest high that traded. If that happens on the top and you lose 20% on the bottom before you realize the bottom's the bottom, you've only got 60% max that you can take out of the move if you buy the low and sell the high within that kind of close to first standard deviation of price trading. So we like to think of it as if you play the second and third standard deviations, the extremes, but you have a way of doing it. And I've had this process and methodology that I approach to trading for 25 plus years. I'm only buying something that's been beaten up enough that the odds are decent that we've picked something darn close to the bottom. So I'm going to fight kind of the textbook theories here and tell, first of all, and this is something I've been saying for 25 years, the fundamentals drive price over time, but the amount that people can be incorrect about fundamentals at any given time can be rather substantial. How is it that analysts, let's say, have the consensus on stock XYZ is that in 12 months it'll be at $80 a share and it's trading at 60, and it's cheap in discounted cash flow or any other metric they're looking at, and they all say it's a buy. But the stock goes to 40 before it maybe turns around and starts heading up. Just because something's cheap doesn't mean it's a buy. Just because something's theoretically worth something up here doesn't mean it ultimately is. There may be other things going on. What investors need to do is look beyond fundamentals. And that's kind of heresy in a lot of places. A lot of firms are built on we only look at fundamentals. And I will tell you that most of the people who only look at fundamentals do not do well any longer. They don't beat their benchmarks. They're lucky if they can even come close to matching their underlying benchmark. Generally, they're trailing. My goal is you've got to outperform benchmarks. You've got to do better than other people on the street because there's so many people playing this game. How do you make yourself stand out? Well, you've got to have a different approach. And I realized 30 years ago, when I was somewhat new in the business, that if I did what everybody else did on the street, I'd just be a Me Too player. Well, a Me Too player doesn't stand out. So when I thought of that in conceptual terms and even statistical terms, it's very hard to outperform when you play the fat part of the bell curve of price movement. If you can buy in the second or third standard deviation of the maximum price move in either direction, you have a much better chance of being positioned correctly at the turn. Then let all the other yahoos push it in the way that you're already positioned for. So when we talk about some of the behavioral biases that affect how people trade, one of the things that we've been able to do, and again, we talk about how I've been able to apply behavioral finance directly to the markets. And I'm not going to give away too much of my good stuff here, but I want you to understand the concept behind this. Let's take something as simple as anchoring bias. When you take that to the marketplace, there's no doubt that 99.9% of all investors will anchor the price they bought the stock at for every other future decision they make regarding that stock. Now, that's irrational. It should not be the way things are done. A classic economic theory would say we're perfect human beings that make perfect decisions that are always rational, so that doesn't exist. We're always going to analyze new information at any given time, make the proper decision. Well, I can tell, I lecture about this all the time. I do corporate training on this all the time. I speak at conferences all the time about this. And I'll always start off with, how many of you pay attention to the price you paid at a stock for all future decisions? And really, 99% of the hands go up. So if you buy a stock at 40, if it goes to 45, you're happy. If it goes to 35, you're not happy. And all your decisions, since you've paid 40 for that stock, is anchored in your head that $40 is your price. In theory, you should be doing analysis on a continual basis to say, should I still be in stock XYZ? Should I be adding to it? Should I be looking to lighten up? Or should I be totally out of it? And that analysis is an ongoing thing based upon all known news at any given time, and not that you paid 40. But if it goes down to 32 and then starts moving up, 99% of investors are going to go, you know what? If I could just get even, I'll get out of this. And so if it gets to 39, 40, 41, boom, they're gone. And this is a game people play all the time. I actually just got out of a stock I had bought back in the fall. I ended up I had watched it kind of fall against, it went my way, then it fell against me, and now it came close. And I said, you know what? I don't think this is a stock I really want to own anymore. So I got out and actually took a $2 loss. It's a $150 stock. I took my $2 loss, and then now it's like 153. And I go, darn, if I had waited 2 more days, I'd be back in the money. But the reality is, I came to a decision that was based upon I don't want to own the stock anymore. And I kind of sucked it up and said, fine. So I take a $2 loss on a $150 stock. It's meaningless. Most people have a really hard time, of taking losses because they have to accept that the decisions they made previously were bad ones or poorly timed ones. And secondly, nobody likes to lose money. So they'll often go for this, some people say you find religion when you have losing trades. And dear God, if it just comes back to where I got in, I promise you I will get out and be a good boy. So knowing also where the market, if you buy a stock at $40 a share, nobody else knows that. So nobody knows that you know where you're anchored, but it doesn't go beyond that. What I've been able to do is develop a methodology such that I can tell where the market is anchored. Collectively, where are people going to be happy and where are people going to be sad and where are people going to start saying, if I could just get back. And I exploit that because I've been able to take this concept of anchoring, bring it directly to the market, figure out collectively where the market is anchored, and play off of that. Because now you're talking about the population of people and understanding the mass psychology that exists at any given point versus just my own. And that's one of the things that we do when I talk about, I taught behavioral finance at NYU. I was the first to teach it there. So academically, I understand the subject matter very well to teach. But very few have taken the concept of behavioral finance and actually been able to trade using the concepts. And that's kind of a real edge I have. Cognitive dissonance is also something that's prevalent in the marketplace all the time. And let me just quickly explain what it is because it's not a term a lot of people know. Cognitive dissonance is essentially the internal battle that goes on inside your body, usually your brain, between doing what you want to do and think you should do versus doing what you think you should do based upon morals of right and wrong. And this is a constant battle that goes on in life all the time. People present, you're often presented in situations where you say, I'd love to do that, but really the right thing is to do this. And so you battle it out and then you choose one of the two. When it comes to the marketplace, think of this, and 2019 is a perfect example. The market's flying from January 2nd straight on, right? We started essentially the day after Christmas flying. There was a large percentage of long-only classic mutual funds that came into this year overweight defensive names and underweight cyclicals because in the fourth quarter, that was the way to be. And it looked like we were probably going to start off that way. Now, the last week of the year's rally may have made some people go, maybe there's something changing here. But then we start off with a tear in January. And if you look at now the momentum that has shifted between, you look at healthcare, real estate, staples, and utilities, kind of the 4 classic defensive sectors, they've been losing momentum, they're losing relative performance, and the cyclical names have actually have picked up. So here you are, Mr. or Mrs. PM, with the fiduciary responsibility to create the best return you can for your clients, and maybe you still think recession is coming and that this is an overreaction on the upside to the, let's say, the gifts that Fed Chair Jay Powell has given us in January that really has helped the market move higher, and that maybe the China deal isn't going to happen, and you're bearish and you kind of think the market's going to take another dive. On the other side of that is I have a responsibility to clients to make them money, and you know what? I've got 2 daughters I've got to marry off in the next 10 years. I've got 3 kids in total I've got to put through college. I need this job. So I've also got to do what's going to save my rear end and make sure I have a job come next year. So I might have to make some decisions that may go against what I think I should do in the market, but it's the right thing to do because I have some other motives besides just being the fiduciary on this account for all my clients. So this battle goes on all the time. And when you have a market tear away, whether up or down, immediately to start a year, you're always going to have people on the wrong side who didn't prepare for a move like that right off the bat. And they've got this internal battle going on between, do I take care of my kids and kind of invest at a much higher price than I really want to, but it'll probably save my rear end, it'll keep me in a job, and at least by the end of first quarter, I'll show that I have certain exposure on in the market, or do I kind of wait for what I think is right when it comes to a market perspective and wait for a pull-off and stay defensive? This is behavioral finance at its best in the marketplace, and again, I'm often looking to exploit and understand what's going on and take these concepts and figure out in the marketplace, how do I take advantage of portfolio managers who are invested in the wrong sectors at the wrong time? Where's the pain trade? Well, the pain trade right now is still straight up. If this year could end up being, and I wrote this a couple weeks ago, and I hope it's not, but if this year turns out to be like 2017, a slow grind higher with low volatility, you're going to blow away. You're going to have a lot of unemployment come the end of this year from Wall Street, because that was not on the table. For 75% of people you asked would never have said that this year would be low volatility after what we just experienced, and that the S&P would just creep higher. And that's what we're doing right now. So when we talk about discipline as a trader and kind of preparation for what you do, I think it's very rare to see somebody approach the markets any differently than they approach life. Trading the markets is done in a very similar fashion as the way you approach life. You tend to be a gambler in life, you're a gambler in the markets. You don't find a gambler in life, somebody who takes risks a lot and then comes to the marketplace and is super conservative. Conversely, if you're pretty darn conservative, you don't generally go to the market and start betting the house on things or trading, lots of commodity futures. The way you run your life is generally the way you trade. So discipline is super important because it is the belief in yourself and your capabilities that ultimately leads to the success or the failure you have. Part of the success that the best traders have is actually getting out when they say this trade's not working. They don't hem and haw, they don't start praying, they don't go to church or synagogue, they just get out. That's a discipline that over time you prove to yourself that you can stick to what you set out to do. Because lots of trades, if you have the mindset that what you're committing capital to is intended to be a short-term trade, this is not something I'm going to have on a year from now. This is taking advantage of some anomaly in the market that's got something mispriced, and I think in the next few weeks or few months, whatever I'm buying here, I can sell out here. But I have no idea long-term if it's a good buy or not, but there's money to make here. So I go with the intention of this being a trade. If the trade starts going against me, but it's still within the parameters that I set out when I first got into it, I'm still okay, even if it's down against me. But if it starts going against me more than I would have ever anticipated, I need to get out. And what most people do is go, this will be an investment. We'll hold this. It'll come back. Well, sometimes that works, but take a name like GE now, and let's say you're long at $30 and you say it'll come back, but it's trading at 10. It may or may not come back, I don't know. But if you had known at 28 it was time to get out because it was only supposed to be a trade to get to 35 and it's not working, you've got to have the discipline to just get out. The more you take your losses and show yourself that you have discipline and you're readily willing to take losses, the more success you'll have over time because you trust yourself. You know that if you get in a sticky situation, you still have the fortitude to act rationally and get out when your gut is telling you this is just not working. So this idea of discipline actually ends up being a tremendous ingredient to success, and you will rarely find any trader on Wall Street who's made good money who does not have discipline. Part of the way that you can deal with emotions is understanding and growing up and facing yourself and kind of knowing who I am, what I'm doing, And am I an adult or still an overgrown child? When you reach the point that you're actually an adult, you can start dealing with yourself as an adult. And as so, you behave differently. I know of people who are still 50-year-old traders who are, 22-year-old kids at heart. And when you talk to them, you still think you're talking to an overgrown kid. And those people generally are not successful traders. So part of it is dealing with the emotions. It's sometimes, if I'm doing a lecture on this, I'll say it's almost similar to an alcoholic who finally gets the fortitude to go to an AA meeting because they've now finally admitted, I have a problem. I need to deal with this. Enough of, all the stories I can tell myself, and I'm not really this, I'm not really that. They've grown up and said it's time to deal with it. It's the same thing when it comes to trading and all the emotions, because God knows everything you are as a person comes out in trading, and the emotions are there, and I thought I was right, and I'm wrong, and am I stupid, and I can't do this, and I've lost 7 days in a row, and will I ever get this game right? And the talk in your head just goes on and on and on. Talk to the best traders in the world, they'll tell you, yeah, that used to happen to me in my 20s, but not now. I got past that because I understand that this game is kind of a flip of a coin, and if I do my analysis correctly, I can sway the odds a little better in my favor. But it's a hard game. It's certainly not easy. Intellectually, it's easy. It's because all you have to do is make a buy or sell decision. It's a lot harder being a brain surgeon or having the knowledge to build a bridge than it is to be a trader, because a trader has just some simple decisions to make. But it's dealing with all the emotions that come in the way that affect your success and or create failure. And how you deal with that is really what ultimately makes you a good trader, or one who just generally contributes money to the marketplace because they've lost money. So how do you correct kind of a bad period that you go through? And it happens to everyone. The best traders in the world can go through a few weeks, months, that stuff's just not working right. One thing is to take a step back. Usually it's taking some time away from the market. And even if you're a professional trader and that's your only source of income, and you go, I can't afford to, take a 2-week vacation, you probably can, because if you keep trading the way you're trading, you're just going to keep losing more money. So part of it is to take a step away, regroup, and I'm actually a fan of meditation. I'm a fan of anything that gets you to reground and focus more on yourself, but I don't mean the neurotic part of yourself, but just where you kind of get grounded again, kind of become whole with yourself, analyze what you've been doing. And sometimes people ask me, for a new trader, what do you say to new traders? How do they learn to be good traders? And the answer is one that's been said for 50 plus years, but I'm going to agree with it. Journal everything you do in the market, every buy and sell decision you make, and every decision you choose not to make. So I was going to buy it, but I held back. Write it down. Why did you do it? After a week, you're going to have a bunch of things that you can read. After a month, you're going to have a fatter book of stuff. And over time, you're going to start seeing there's certain repetitive patterns that this situation keeps coming up and I do that. Now, when this happens and I do that, did I make money or lose money? If I made money, then my analysis is correct. If I'm losing money, I need to change what I'm doing. Because if I keep doing it over and over again, right, I'm going to have the same results. So if you'll never remember all the trades you did and why you did them. So if you actually write them down, it's therapeutic in a sense. You're expressing your emotions and what you were thinking about as you were making those decisions. It's a good way to get in touch with yourself. And I know it sounds like very, I can't think of the word, but like old-fashioned or something. But the reality is, it's your way of getting in touch with yourself of what you're doing and the decision-making that you're doing and why you're doing what you're doing. And it's a good way of kind of seeing what patterns you do. And then you can see 20 times I did this and 16 victories in the market. That's a good thing to be doing. 20 times I did that and I lost, 14 times. It's probably not the right thing to be doing. So actually keeping a journal of what you do, as silly as it sounds, is the best thing you can do. Behavioral finance is one of the hottest topics on the streets, and more major firms, tier one firms on the street, are investing in behavioral finance. They're actually making small departments in this area because they realize there is significance here. The interesting part to me is that, and this is really a growth of 4 Nobel Prize winners in the last, since 2000, and I can't remember if it was 2002 or 2003, Danny Kahneman and Amos Tversky won the Nobel Prize in Behavioral Sciences, kind of the first people in behavioral economics. Then you had Daniel Schiller, maybe, 6 years ago, and Richard Thaler a couple years ago, University of Chicago, win for behavioral sciences and economics. So people are realizing just how important the whole meaningfulness of psychology, especially as it relates to financial decision making, is apropos to anybody who's in this business, whether you're a broker or financial advisor, whether you're a portfolio manager, whether you're a trader, whether you're an analyst. How you grew up, how you were taught about money, and what your relationship to money is as you developed into an adult is a critical influencing factor in how you approach every financial decision you make. And so people, now that this academic theory has been brought much more into the public limelight, people are realizing this. And for instance, I do a lot of performance coaching to financial advisors, especially on behavioral finance and how to incorporate it into their sales process, both for them to better understand their relationship to finance. And then once they can do that, they're much better off being able to have the conversation with their clients and introduce certain subject matters that will elicit better responses from clients than the traditional sales methodology that a financial advisor would have done 10, 15, 20, 30 years ago. So the conversation itself has actually changed for the better. On the street, I've been using behavioral finance before it even had this fancy name. I realized back in the 80s that the psychology, and a lot of this came from being in the pits. The guy I stood next to in the stock index pit printed money every day. It was unbelievable. Now, we stand shoulder to shoulder for several years. What is he looking at? What is he doing? I'm looking up at screens, other prices, the bond market, anything that can give me a sense of, do I really kind of want to be more of a bidder or a seller? How is it that this guy standing next to me, he wasn't smarter than me intellectually, but somehow there was something in him that was able to play this game better. And I am in complete assurance that it had to do with the psychology that he walks into the marketplace every day. One thing was, if this guy lost early in the day, he refused to go home a loser. If I lost a couple $1,000s early in the day, I'm like, I'm stopping. I don't want to lose anymore. It's a bad day. I'm out of sync in the market. So part of it was his tenacity to say, I refuse to go home a loser. And for several years, he didn't have a single losing day. That's psychology. That's a tenacity. That is a focus that has to do with the success he was able to build. So there is a process. There is this important level in really understanding yourself, your strengths, your weaknesses, what you're good at, what you're bad at, understanding them and acknowledging them. And sometimes that doesn't come until you're an adult. But like even in the markets, I knew after being in the pit for so many years, I could sell strength, I could sell weakness. So market's going down, I'll help push it down. I'd buy weakness, but I always had trouble buying strength. I was always afraid that as the market's moving up, if I buy it, that's going to be the top. And it's an irrational fear. And I traded in the 80s and 90s, one of the best bull markets there ever was, and yet I had the hardest time actually being long if I had to chase after the market. That stuff you learn yourself, and that knowing that helped me over time. So the psychology portion of trading is huge. And the more Wall Street kind of finally accepts that, the more they're willing to open their eyes that there are other ways than simply looking at discounted cash flow, EBITDA, or anything else a fundamental analyst is looking at, because half of all price movement in the market has nothing to do with fundamentals. It has to do with everything but fundamentals. Well, one of the best things I liked about working at Morgan Stanley in the strategy area was that this was a firm that believed and came from a thought process that if you had done your analysis, you could make the call, the official call, but there were 5 of us in strategy, And those calls didn't always match. Whereas many firms, they want one call to come from the firm. We're officially bullish the stock market. Well, when I worked at Morgan Stanley, it wasn't like that. There are times we disagree, and the audience, whether it was our sales force or our clients, loved it. And Steve Roach and Byron used to go on the road all the time, and often they were completely opposed to each other. And it was great showmanship, not intended to be, but everybody loved it. So I think it was back in 2005. Steve Roach had been looking for rates to go higher for quite some time. I think it was June. And he finally threw in the towel and said rates were going lower on the U.S. 10-year. And he was ultimately correct because rates went well down. But the same morning that Steve announced to the firm that rates were going lower, I was the next speaker on the dais presenting to the sales force. And I said, rates are going straight up from here. So, of course, the audience fell off their chairs laughing because you've got the chief economist saying rates are going down, and you've got the chief market strategist going rates are going up. And so Steve and I were in complete disagreement. And here's the difference. Economists are typically brilliant people who think in big terms and big picture stuff. But they're not generally saying that this is going to happen in the next 2 months, 3 months, or it could be 3 to 5 year type broader picture. Whereas as a market strategist, I'm much more concerned with where's the next move coming that we can exploit and take advantage of. If I recall correctly, it took 23 months for interest rates to ever come back down to that level that they were that day. And eventually they went lower. So Steve was ultimately correct, but it took almost 2 years, whereas for 2 years, rates had gone up. So I'd say that was probably the biggest disagreement I had. And we were both right, but in totally different time frames. For 2 years I was right. Ultimately, he was correct. Most people on the street have a lifespan of the current fiscal year of whatever their fiscal year is. If you're a hedge fund, whether you're December 1st to November 30th or a mutual fund with similar, or January to December, you're living in kind of a 12-month period because that's what you're getting benchmarked. That's what investors care about. So, looking out 3 years, 5 years down the road is beyond what I even tend to think about because I'm looking at what's going to work now to make people money. So, kind of a different approach. Not one's better or worse, just different.
Let's play a game. I'm going to read out 3 sentences. You have to guess what they have in common. All right, here we go. Sentence number 1. This has literally changed my life. I'm currently up enough on this trade to pay off my house. Here's sentence number 2. This call has been absolutely spot on. It has made a big difference to my year and portfolio returns. I'm likely up 30% by the end of the year. And sentence number 3. It's effectively a macro mentoring program from 2 of the best. Give up? Each sentence comes from one of our many subscribers to Macro Insiders. That's the actionable macro mentoring service from Raoul Pal and Julian Brigden. To play along yourself, check out Macro Insiders today to see what kind of membership works for you.